Texas land once felt like it was almost guaranteed wealth. Buyers treated property across the state as a sure path to profit, and builders struggled to keep up with demand. But that era has shifted, and now many new subdivisions are starting to look less like thriving communities and more like overpriced, half-empty developments. I've been tracking deep price cuts, heavy builder incentives, and unfinished neighborhoods where concrete slabs sit under the Texas sun. The old frenzy of bidding wars is gone, replaced by a clear slowdown where momentum has reversed and builders are increasingly under pressure. In many places, even polished model homes feel unusually quiet, with sales agents now treating every visitor like a critical opportunity rather than a routine walk-in. Stay for the full breakdown because what's unfolding across Texas is difficult to ignore, from struggling developments near major cities to suburban areas where builders are offering extreme incentives just to move inventory. The pressure is visible everywhere: empty streets, constant price reductions, and aggressive promotions. What we're seeing now is one of the most significant construction slowdowns Texas has experienced in years. Number 10. Lubbock. Out on the dry plains of West Texas, the wind is no longer carrying optimism for home builders. These days, it is carrying warning signs. For years, developers treated this growing college city like an unlimited source of easy money, convinced that students, first-time buyers, and expanding families would continue flooding into endless rows of four-bedroom brick houses stretching toward the desert horizon. Now the mood has completely changed. Empty cul-de-sacs sit eerily quiet, and it almost feels like tumbleweeds are moving faster through these neighborhoods than potential buyers. The slowdown is becoming impossible to hide. I dug through the latest data from the Lubbock Association of Realtors, and the numbers paint a rough picture for anyone heavily invested in local real estate. Active home listings have jumped by more than 40% compared to this time last year. That is a massive increase in supply, hitting a market that suddenly looks exhausted. Imagine trying to launch a brand new phase of construction while roughly 1,500 homes are already sitting unsold across the area. Builders are no longer competing only against each other. They are now battling a growing wave of anxious homeowners trying to unload resale properties before prices slip any further. According to figures from the Texas Real Estate Research Center, the average home in the region is now lingering on the market for more than 65 days. On paper, that may not sound catastrophic. But for large construction companies carrying expensive loans and high interest payments, every extra day without a buyer becomes financially painful, and the pressure is starting to show everywhere. Zillow data reveals that nearly a quarter of all listings in the area have already gone through price reductions within just the past month. Sellers are blinking first, and builders are being forced to follow. At the same time, Realtor.com reports that the median listing price has stalled around $299,000. That creates a serious problem for developers who purchased land during the peak of the pandemic frenzy, when prices for raw property were dramatically inflated. Many of them simply cannot profit at current price levels without taking substantial losses. Honestly, it is difficult watching local contractors and developers come to terms with the fact that the boom years may be over. A recent report from the National Association of Home Builders showed that buyer traffic across the region has fallen to its weakest levels since 2019. And that decline changes everything. You can pack homes with oversized islands, trendy open floor plans, and polished quartz countertops. But none of that matters if buyers are financially drained by mortgage rates hovering around 7%. At that point, those beautifully staged kitchens stop looking like dream homes and start looking like very expensive storage rooms collecting dust. Number 9. Temple. Located right along the Interstate 35 corridor, this city was once marketed as the perfect escape hatch for Central Texas buyers who could no longer afford places like Austin and the surrounding metro areas. Developers saw opportunity everywhere. Huge stretches of farmland were snapped up almost overnight and transformed into block after block of brand new starter homes aimed at commuters chasing affordability. But that affordable home dream has started unraveling fast, and what was supposed to be a booming expansion is beginning to look more like a serious builder crisis. I spent some time reviewing recent housing reports from Redfin, and the warning signs are impossible to miss. Inventory tied to new construction has exploded by roughly 52% compared to last year. That is an enormous surge of unsold homes piling up in a market where demand is no longer keeping pace. Imagine being a small contractor who just wrapped up an entire row of speculative homes, expecting eager buyers to flood the open houses every weekend, only to stand there listening to complete silence. No crowds, no bidding wars, just empty driveways and sales flags flapping in the wind. The latest numbers from the Temple Belton Board of Realtors paint an especially grim picture for anyone tied to the construction business. Closed home sales in the area have fallen by nearly 15%, which means a huge portion of buyers has simply disappeared from the market. Builders are responding the only way they know how. They are throwing money at the problem in hopes of reviving demand. According to a recent survey from John Burns, real estate consulting, nearly 60% of builders in this region are now offering major incentives, including mortgage rate buydowns, pushing financing into the low 5% range. Think about how extreme that really is. Developers are sacrificing tens of thousands of dollars per property just to help buyers qualify for loans. That is not confidence. That is damage control. The pressure keeps growing when you look at how long homes are sitting unsold. Zillow analytics show that the median time on market for newly built homes in Temple has now stretched beyond 70 days. For builders carrying construction loans, maintenance costs, insurance, and taxes, every extra month without a sale becomes financially draining. And the tax situation is making things even worse. Property valuations from the Bell County Appraisal District have remained stubbornly high, leaving developers stuck paying heavy tax bills on homes and lots that are sitting completely vacant. Honestly, the people I feel for most are the everyday construction workers caught in the middle of all this. As projects slow down, hours are being reduced because major developers are increasingly afraid to start new phases of construction. Housing Wire recently reported that single-family building permits across the area have dropped by roughly 30%. That statistic says a lot. When builders suddenly stop pulling permits and slam the brakes on future projects, it usually means serious concern is spreading behind the scenes inside corporate offices. Number 8. Waco. Apparently, covering homes with shiplap walls and calling every neighborhood a modern farmhouse community is not enough to protect a market from reality. For years, Waco rode the momentum of television fame and national attention, convincing investors, developers, and large home-building companies that demand here would grow forever. The city became a magnet for out-of-town buyers chasing the small-town Texas lifestyle they saw on television. Builders responded by pouring money into massive developments, assuming people would continue paying premium prices no matter how expensive things became. But now that hype is fading, and the slowdown hitting the market is becoming painfully obvious, construction crews that once worked nonstop are now staring at half-empty subdivisions, vacant lots, and shrinking profit margins that get tighter every month. I started digging through recent numbers from the Waco Association of Realtors, and the market hangover looks severe. Housing inventory has climbed to more than 4 months of supply. Historically, that level might sound fairly normal. But for builders who became accustomed to selling homes before the concrete foundations were even poured, this shift feels enormous. Imagine completing a brand new subdivision with 30 freshly finished homes, only to open Redfin and discover that roughly 42% of active listings nearby have already reduced their asking prices. That kind of data spreads panic quickly, and you can feel the desperation building. According to the Texas Real Estate Research Center, overall home sales volume across the county has dropped by nearly 20%. Buyers are pulling back because the numbers simply no longer work for many households. The problem is especially clear when you look at pricing. A recent Realtor.com analysis showed that the median listing price for newly built homes in the area remains stuck near $380,000. For many local residents earning ordinary wages, that figure feels completely out of reach. Builders are now trapped in a difficult position. During the boom years, they paid inflated prices for land, labor, and construction materials. But today, buyers are demanding discounts while borrowing costs remain painfully high. As a result, developers are being forced to hand out expensive upgrades, closing incentives, and financing deals just to convince someone to sign a contract. Even then, many deals are still collapsing. Builder magazine recently reported that cancellation rates for new home contracts across Central Texas have climbed above 16%. That means roughly 1 out of every 6 buyers backs out before the transaction is completed, leaving builders stuck carrying unsold inventory and mounting costs. At the end of the day, this is what happens when supply outruns reality. Developers assumed they could endlessly pave over Central Texas farmland, attach luxury price tags to ordinary suburban homes, and count on non-stop demand forever. But eventually, affordability catches up with every market, and Waco is learning that lesson the hard way. Number 7. McKinney. Up in the northern edge of the Dallas-Fort Worth metro area, the luxury housing boom is starting to slam into reality. For years, this city was treated like the crown jewel of suburban expansion, packed with massive master-planned communities filled with oversized brick homes, manicured streets, and promises of endless corporate relocations fueling demand forever. Developers built with incredible confidence. They assumed high-income buyers moving into North Texas would continue scooping up expensive homes as quickly as they could be completed. But now, many of those giant suburban mini-mansions are sitting eerily quiet, gathering dust while builders absorb enormous carrying costs and rising property taxes. I looked over the latest numbers from the Collin County Association of Realtors, and the inventory growth is impossible to ignore. Active listings have climbed more than 35% compared to the same period last year. That is a dramatic shift for a market that not long ago felt nearly unstoppable. Imagine being a developer who borrowed millions at interest rates near 8% to finance an upscale neighborhood full of $700,000 homes. At the height of the frenzy, that probably looked like a safe bet. Today, many of those same builders are staring at empty model homes and shrinking buyer traffic, wondering where all the demand went. The latest Zillow data makes the situation look even worse for the construction industry. Nearly 1/3 of homes currently listed in the area have already gone through price reductions, and these are not tiny cuts either. Builders are dropping prices by $20,000 or even $30,000 at a time just to bring potential buyers through the front door. At this point, it is turning into a race to the bottom. Every builder is trying to out-incentivize the next one before inventory piles up even further. I also came across a recent Metro Study market update showing that new housing starts in this northern section of the Metroplex have fallen by around 28%. That tells you everything you need to know about builder confidence right now. Large corporate developers are refusing to break ground on new projects until they can unload the growing backlog of unsold homes already weighing them down. What really stands out is how dramatically the power dynamic has shifted. Families walking into sales centers today know they are no longer competing against crowds of desperate buyers. They understand the leverage is finally on their side. Redfin reports that the median time homes are spending on the market has now stretched beyond 65 days. In response, builders are becoming increasingly aggressive with incentives. Free luxury appliance packages, paid closing costs, and even covered HOA fees for the first year are all being thrown onto the table just to keep deals alive. According to a recent report from the Dallas Morning News, local contractors are suffering through their weakest quarter for new orders in more than 4 years. The non-stop suburban expansion that once seemed limitless has finally started running into a very hard reality. Ordinary buyers simply cannot keep up with these prices anymore. And behind the polished sales offices and glossy marketing brochures, the anxiety inside the industry is becoming impossible to hide. Number 6. Denton. Up near the northern end of the so-called Golden Triangle, the land development frenzy has started falling apart in dramatic fashion. Over the last several years, builders treated this entire area like a non-stop production line, rapidly transforming open horse pastures and rural land into tightly packed subdivisions filled with nearly identical homes. The entire strategy depended on one major assumption: that an endless stream of commuters would continue accepting brutal drives into the Dallas-Fort Worth area just to achieve homeownership. For a while, that gamble seemed to work. But now, the momentum has collapsed, and many builders look completely stuck. I spent some time reviewing recent housing data from the Greater Denton Association of Realtors, and for new construction, the situation looks ugly. Inventory has climbed beyond a 4-month supply, a sharp shift for a market that was overheated not long ago. Picture being a local builder with 20 houses currently sitting mid-construction, framing exposed, crews still working, and financing costs piling up by the day. Then, imagine opening the latest Redfin numbers and seeing that total home sales in the region have fallen nearly 18% compared to last year. That is the kind of statistic that keeps developers awake at night. The buyers who once flooded these suburban developments have largely disappeared. Instead of rushing to sign contracts, many families are staying put, waiting, or realizing they simply cannot afford the monthly payments anymore. And affordability here has become a serious problem. Realtor.com data shows the median listing price hovering around $425,000. At today's mortgage rates, that translates into payments that are crushing for many middle-class households. Deep down, builders know they pushed prices too far. Zillow reports that roughly 38% of homes currently listed in this market have already gone through price reductions. Every day feels like a standoff between nervous developers trying to protect their margins and cautious buyers refusing to jump into a declining market too early. The incentives being offered now are becoming increasingly aggressive. I came across a report from the Texas Real Estate Research Center showing that builder permit activity has dropped by about 22%. That decline says a lot about confidence levels. Few developers want to risk launching another project while existing inventory continues piling up. Meanwhile, John Burns Real Estate Consulting reports that builder concessions in the area have reached record levels. Many developers are now offering incentives exceeding $25,000 just to get deals signed and move homes off their books. At this point, the tension is almost visible. Behind the fresh paint, staged furniture, and polished sales pitches, you can sense the anxiety building. Denton's developers created an enormous suburban expansion aimed squarely at the middle class, but the problem is that many middle-class buyers can no longer afford the cost of admission. Number 5. Conroe. Far north of Houston, tucked into the pine-covered stretches of East Texas, the dream of non-stop master-planned expansion is beginning to crack apart fast. For years, developers poured enormous amounts of money into these massive suburban communities, building the image of a perfect lifestyle where families would gladly accept long commutes in exchange for oversized homes, giant backyards, resort-style pools, and endless neighborhood amenities. During the boom, it all looked unstoppable. Entire forests were cleared to make room for gigantic developments designed to function like self-contained suburban cities. But now, many of those once busy amenity centers feel strangely quiet, and behind the scenes, builders are growing increasingly nervous. I went through the latest figures from the Houston Association of Realtors, and the numbers paint a rough picture. Active listings in the area have surged by more than 40%, flooding the market with far more homes than buyers seem willing or able to absorb. Imagine being a project manager for a major national builder, standing in the middle of hundreds of newly poured foundations, knowing that customer traffic has slowed to a crawl. Streets that were expected to fill quickly with buyers are instead lined with unsold inventory and mounting financial pressure. At some point, the numbers simply stop working. According to Redfin Analytics, homes in this region are now sitting on the market for an average of 72 days. For giant building companies that rely on rapid turnover to keep cash flowing, that kind of delay is brutal. Every unsold home becomes an expensive liability, accumulating interest, taxes, insurance costs, and maintenance expenses month after month. The pressure is starting to show in pricing too. Zillow data indicates that nearly 30% of active listings in the area have already received price cuts. Builders are quietly lowering base prices and layering on incentives while still trying to project confidence through polished marketing campaigns and upbeat promotional emails. What makes the situation especially frustrating is how disconnected prices have become from local incomes. Conroe used to be viewed as a relatively affordable alternative to Houston's more expensive suburbs. But according to a recent Metro Study housing report, the median price for new construction has climbed well above $350,000, pushing many working families completely out of the market. And as the slowdown intensifies, developers are becoming increasingly desperate to keep deals alive. The National Association of Home Builders reports that cancellation rates in the area have now risen beyond 18%, meaning a huge number of buyers are walking away from contracts at the final moment. Some people are even forfeiting their earnest money deposits just to avoid locking themselves into monthly mortgage payments that no longer feel manageable at today's interest rates. The reality is simple. You cannot clear thousands of acres of forest, build thousands of homes at the same time, and expect demand to absorb all of it smoothly while mortgage rates hover near 7%. The expansion frenzy pushed too far, too fast, and now the correction that many people ignored for years is finally arriving. Number 4. Katy. On the western outskirts of the Houston metro area, one of Texas's most dominant suburban growth machines is finally starting to crack under pressure. For more than a decade, this area represented non-stop expansion. Massive subdivisions stretched endlessly across former farmland, filled with oversized houses, giant school campuses, and promises of the perfect suburban lifestyle. Developers truly believed the growth would continue forever. Every year seemed to bring another wave of construction pushing farther outward, as if the suburbs would eventually spill into the next county without ever slowing down. But now that momentum is fading fast, and builders are running headfirst into a wall of exhausted buyers. I spent time reviewing the latest market numbers from the Houston Association of Realtors, and the buildup of unsold inventory is becoming impossible to ignore. Compared to the frenzy of the pandemic years, the amount of available housing has roughly doubled. Imagine being a sales representative stuck inside one of these perfectly staged, freezing cold model homes, spending entire days staring out at empty streets with barely any foot traffic coming through the doors. After a while, that kind of silence starts feeling less like sales work and more like psychological torture. According to Redfin, closed home sales across the area have fallen by more than 15%. The massive suburban migration wave that once fueled this market has clearly lost steam. But the real problem comes down to affordability. Zillow data shows the median home price in Katy still hovering around $440,000. And once you combine that price with today's mortgage rates, rising insurance costs, and notoriously high local property taxes, the monthly payment becomes overwhelming for many middle-class families. That is the nightmare builders are now facing. Prices remain too high for buyers, but developers also cannot slash prices aggressively without seriously damaging their own finances and wiping out profits. To keep deals alive, builders are becoming increasingly aggressive with incentives. A recent survey from John Burns Real Estate Consulting found that developers in this western Houston corridor are offering some of the largest mortgage rate buydowns anywhere in the country. In many cases, they are spending $30,000 or more per buyer just to make financing affordable enough for lenders to approve the loan. And the anxiety inside the industry is spreading quickly. Housing Wire recently reported that new single-family building permits in the area have dropped roughly 25%, a strong signal that developers are deeply hesitant to begin new projects. At this point, many major builders are afraid to move another shovel of dirt until they clear the growing backlog of unsold homes already sitting on the market. Realtor.com also notes that close to 40% of active listings in the area have already undergone price reductions. The shift is dramatic. Neighborhoods that once required waiting lists and lottery-style systems to secure a home are now filled with giant neon signs, desperate promotions, and empty model homes begging people to stop in for a tour. Number 3. San Antonio. Down in the Alamo City, home builders are increasingly trapped under the weight of an enormous inventory problem. For years, San Antonio was promoted as the final affordable major metro area in Texas, a place where families priced out of Austin, Dallas, and Houston could still realistically buy a home. Developers responded by expanding aggressively across the outer edges of the city. Entire entry-level communities were built at lightning speed as bulldozers cleared brush and farmland nonstop. The assumption was simple. Demand would continue forever. But now the market looks flooded, and the pressure inside the construction industry is reaching extreme levels. I went through the latest report from the San Antonio Board of Realtors, and the numbers are rough. Active housing inventory has exploded by roughly 70% compared to last year. That is not a small correction. That is a dramatic oversupply hitting a market that no longer has enough qualified buyers to absorb it. Imagine the atmosphere inside a builder's boardroom when executives realize they are sitting on hundreds of completed homes with no buyers in sight, only to discover that competing developments across the street are facing the exact same crisis. At that point, every builder starts fighting for survival. According to Redfin, the median time homes are spending on the market has now climbed past 80 days. In the world of new construction, that kind of delay feels endless. Carrying costs pile up quickly, financing becomes more painful, and every unsold property turns into a growing financial burden. Zillow Analytics revealed just how severe the situation has become. Nearly 42% of active listings across the area have already seen price reductions. Builders are undercutting each other aggressively, trying to secure buyers before the market softens even further. And honestly, it is hard not to feel sympathy for people who purchased homes at the absolute peak of the frenzy in 2022. Some buyers are now watching builders slash prices on identical homes next door by $40,000 or more, instantly damaging the value of what they just bought. The affordability crunch is hitting first-time buyers especially hard. A recent study from the Texas Real Estate Research Center found that sales of homes priced under $300,000 have fallen by more than 20%. Ironically, that is the exact buyer segment many of these developments were originally designed to target. The problem is that those buyers are increasingly locked out by high mortgage rates, rising insurance costs, taxes, and overall living expenses. The math simply no longer works for many households. To keep inventory moving, builders are offering increasingly desperate incentives. Builder Magazine recently reported that local developers are covering closing costs, installing free landscaping packages, and heavily buying down mortgage rates just to keep transactions alive. Yet even with all those giveaways, demand remains weak. The National Association of Home Builders says buyer traffic across the area is still sitting near multi-year lows. The vision of San Antonio as an endlessly affordable housing haven has started fading fast, disappearing into the Texas heat, along with the easy money optimism that fueled the boom. Number 2. Georgetown. Not long ago, this city was celebrated as the fastest-growing place in the entire United States. That title sent developers into a frenzy. They rushed north of Austin, grabbing every available parcel of land they could get their hands on, from rocky scrubland to empty fields, convinced nothing could possibly slow the momentum. Construction exploded at a pace driven by confidence, almost bordering on overconfidence. Homes were priced as if the tech-fueled expansion around Austin would continue indefinitely, with demand rising forever. But that assumption has now collapsed, and what's left is a market weighed down by excess supply and stalled growth. I went through localized figures from the Austin Board of Realtors, and the reversal here is striking. Active inventory has climbed to the equivalent of nearly a 5-month supply. For a former high-growth hotspot, that kind of shift feels like hitting a wall at full speed. Try to picture an investor who bought multiple speculative homes in a brand-new master-planned community, expecting rapid appreciation and instant demand. Instead, they're now looking at quiet streets, unfinished landscaping, and empty houses surrounded by overgrown grass and silence. The pressure on the market is intense. Redfin data shows that median sale prices in the area have fallen by more than 8% year over year. That is a significant loss of value happening in real time, wiping out gains that many assumed were secure. Zillow reports that roughly 45% of listings in Georgetown have already gone through price cuts. When nearly half the market is actively reducing prices, it signals widespread urgency rather than isolated corrections. At the same time, a deeper slowdown is becoming visible. A recent Metro study analysis found that new housing starts in this corridor have dropped by more than 35%. That is a major pullback from the aggressive expansion mindset that defined the boom years. In response, large developers are stepping back. Many have paused or entirely halted future phases of construction because they are already overexposed to unsold inventory. The shift in sentiment has been rapid, and in many ways, brutal. Realtor.com data shows homes are now sitting on the market for an average of nearly 85 days. To counter the lack of buyer activity, builders are turning to increasingly aggressive marketing, including radio ads and direct promotions that essentially invite buyers to tour empty, unsold homes. And according to a recent report in a local business journal, Some developers are now offering more than $40,000 in incentive flex cash just to close deals. What makes it all so striking is how quickly the narrative has flipped. Georgetown was once seen as unstoppable growth embodied in suburb form. Now it looks like a cautionary tale of what happens when supply races far ahead of real demand, leaving behind thousands of homes built for a wave of buyers that never fully materialized. Number 1. Austin. This is the epicenter of what many are now calling the Texas construction downturn. For years, Austin was the symbol of the pandemic-era housing boom, where developers acted with extreme confidence, sometimes even arrogance, pushing premium prices, running restrictive lottery-style sales, and treating eager buyers like they had no leverage at all. But that phase is over. The momentum has reversed sharply, and the same tech-driven housing surge that once fueled explosive growth has now collapsed under its own weight, leaving many builders stuck in a difficult and increasingly risky financial position. I reviewed the latest data from the Austin Board of Realtors, and the situation on the ground is clearly deteriorating for sellers. Active inventory has climbed to its highest level in more than 8 years. That kind of buildup signals a major shift from scarcity to surplus. Picture a luxury custom home builder carrying a heavily leveraged $2 million spec property, expecting tech professionals and high-income relocations to keep demand strong. Instead, migration has slowed, local demand is exhausted, and those high-end model homes are sitting quiet, with little to no foot traffic. The silence in those spaces says everything. Redfin data highlights the severity of the correction. Median home prices across the metro have fallen by more than 10% from their peak. That kind of drop is not just a minor adjustment, it erases profit margins and forces builders into defensive survival mode. Zillow analytics show that nearly 48% of active listings have undergone price reductions. When almost half of the market is cutting prices, it is no longer isolated weakness. It is widespread repricing happening across the entire system. There is also a real human side to this. Many local homeowners are now dealing with property tax assessments that were based on peak pandemic valuations, even as actual market values decline. That disconnect is adding another layer of financial pressure across the region. Meanwhile, desperation among developers is reaching new highs. According to John Burns Real Estate Consulting, Austin builders are among the most aggressive in the country when it comes to price cuts and incentives. Many are offering permanent interest rate buydowns into the high 4% range just to prevent buyers from backing out of contracts. Housing Wire reports that single-family building permits in the metro have dropped by around 40% year over year. That is a dramatic pullback, and it reflects a simple truth. Builders are no longer confident enough to keep expanding. The cranes that once dominated the skyline are starting to disappear. Projects are being paused, future phases are being delayed. And developers who once felt untouchable during the 2021 boom are now fighting aggressively just to stay solvent. At its core, this is what happens when supply gets too far ahead of real demand. And now, Texas is working through the consequences of that imbalance in real time. I hope this breakdown gave you a clearer view of what is actually happening beneath the headlines.